Most price displacements fail when it matters most. You see a clean breakout with strong momentum, but then it reverses without warning. Why? Because that move happened with thin participation, a liquidity void, which is exactly why you need to see this oscillator that detects inefficient price moves prone to mean reversion. In this video, I'm going to reveal this indicator to you, show you the perfect settings, and give you a complete strategy to finally catch these moves. Let's get into it. First, head over to TradingView and pull up any chart you want. I'm using the 15-minute time frame on pound yen, but this works on any market, any time frame. Click on indicators and type in liquidity void detector. Make sure you select the one by Zierman. Now this isn't your regular momentum oscillator. No, this is much better. Most indicators just show you price displacement, but this one, it measures the most recent price move and amplifies it only when volume is below its own trend, catching inefficient displacements that are prone to mean reversion. Let me show you how it works. You've got the oscillator at the bottom that changes between positive and negative readings. Positive readings mean a strong up move on low volume, a potential buy-side imbalance with a void below that often refills. Negative readings mean a strong down move on low volume, a potential sell-side imbalance with a void above that often refills. But it gets better. It also computes a volume shock by comparing current volume to a rolling baseline, then z-scores it. Bars with volume shock below the threshold are treated as low volume or thin participation. Then it calculates the 1-bar log return, and z-scores that too, showing whether the latest move is unusually large. So when volume is low, the price return gets amplified, and when volume is normal or high, the signal fades. This means you're only seeing moves that traveled far on thin volume, the exact definition of a liquidity void that markets want to fill. Most traders struggle because they rely on random signals without a clear system. That's why we focus on structured strategies and automation, so you can study how these tools work step by step without guesswork or emotions. If you want a free demo to see exactly how these strategies are applied in real market conditions, click the first link in the description. Now, for maximum void detection accuracy, let's get your settings right. Double-click on the indicator to access the settings panel. You'll see the volume baseline length, which defines how many bars are used for the volume trend in the volume shock calculation. I recommend you set this to 60 bars, as larger values create a smoother baseline with fewer low volume flags, which is perfect for filtering out noise. Next, set the vol shock z-score lookback to 50 bars for optimal smoothing without losing responsiveness to genuine thin volume conditions. Now for the critical setting, low volume threshold, which defines what qualifies as thin participation. The typical range is between -0.5 to -1.0, but setting it to -0.7 strikes the perfect balance between catching meaningful voids and avoiding false signals. After that, set the return z-score. Look back to 40 bars to standardize the 1-bar return extremeness measure. Finally, set the fade when volume not low factor to 0.20. This means when volume is normal or high, the oscillator weight drops to 20% instead of being ignored entirely. Under the Style tab, set upper threshold to +1.2 for sell-side imbalance triggers, and lower threshold to -1.2 for buy-side imbalance triggers. Once that's done, click OK. Now let me show you exactly how to trade sell-side imbalances. That is, aggressive sell moves on low volume where you expect price to move up to fill the void. To trade this, first, watch for the oscillator to drop below the lower threshold of -1.2, signal that an aggressive down move happened on thin participation. When you see this, it means the market just created a sell-side imbalance, a void above current price that often gets filled. But don't enter immediately on the signal. You want to wait for the oscillator to start turning back up from the extreme negative reading, confirmation that the inefficient down move is losing momentum and mean reversion is beginning. Next, check your price action. You want to see a bullish engulfing candle or a strong rejection wick at support, which gives you confluence between the void detector signal and actual price structure. For entry, go long when the oscillator crosses back above -1.0 after touching the extreme. Place your stop loss below the low of the void candle, the candle that created the extreme oscillator reading. For take profit, target the high of the void candle first, then extend to previous resistance if momentum continues. The beauty of this strategy is you're not predicting, you're reacting to statistical inefficiency. For buy-side imbalances, that is, aggressive buy moves on low volume where you expect price to move down to fill the void. First, watch for the oscillator to spike above the upper threshold of +1.2, a signal that an aggressive up move has happened on thin participation. Again, don't enter immediately. Wait for the oscillator to start turning back down from the extreme positive reading. This confirms the inefficient up move is exhausting and mean reversion is beginning. Then, check your price action for confluence. You want to see a bearish engulfing candle or strong rejection wick at resistance. Enter when the oscillator crosses back below, +1.0 after touching the extreme. Place your stop loss above the high of the void candle and target the low of the void candle. The key difference between this and regular overbought, oversold trading is the volume filter. You're not just catching exhaustion, you're catching inefficiency. The oscillator only fires extreme readings when big moves happen on abnormally thin volume. That's what makes these voids statistically likely to fill. unlike regular momentum extremes that can extend indefinitely during high-volume trending conditions. Now, different markets require different settings for optimal void detection. For forex pairs, especially majors, set your volume baseline length to 70 bars and increase the low volume threshold to -0.8. Forex markets have institutional manipulation during session overlaps that can create false void signals. These conservative settings filter out the noise and focus only on genuine thin volume displacements. Focus on trading voids that form during Asian session quiet periods, as these tend to fill during London or New York opens when participation returns. For crypto, drop volume baseline length to 50 bars and set low volume threshold to -0.6. Crypto has more frequent liquidity voids due to fragmented exchange volumes and whale manipulation, so more sensitive settings catch these opportunities earlier. For gold, set volume baseline length to 65 bars and low volume threshold to -0.75. Gold exhibits violent void formations during news releases and session opens, so these settings balance sensitivity with reliability during gold's unique volatility profile. For stocks, keep volume baseline length at 60 bars, but tighten the low volume threshold to -0.8. Avoid void signals during the first 15 minutes after market open, as these often represent normal price discovery rather than inefficient displacements. Thanks for watching, and I'll see you in the next one.